What's up? Good morning, everybody. What's going on? Welcome to Trading with Bubba. And of course, as we had talked about all week on the updates and on Tuesday, we expected a pretty large rally, and look what we got. We got a pretty large rally. Okay, you got a spike up in the Qs. You got a spike up in the S&P, the SPY. Look, these are things that we talk about all the time. This is the opportunity now that we were looking for, an opportunity to sell. We were talking about waiting for the right opportunity, and I think now is probably the right opportunity. And you had a Fed meeting on Wednesday, yesterday, which was caused this big short squeeze, as we call it, a rip your face off rally. And now that we've seen it, I think now is a time that you look to be a potential seller. If you look at some of the shorter term stuff, okay, and these are the futures, but again, they're correlated to the equities. You get the Nasdaq, okay. You got everything is higher, and it would not surprise me in the least if these markets turned over even today. Now, again, the one interesting fly in the ointment is the jobs number tomorrow. But as we watch and look here, you can see that we've kind of peaked out here. One of the things I think you want to take note of is the lack of volume. Even the rally yesterday was on light volume. But what we're talking about in markets is what are expectations, and not expectations that we build based on the news. It's expectations you built on the price action. It is expectations that you built on the price action, the market, the map of the market, the chart. And again, if we go back and look, and we've talked about the Bollinger Bands a couple of times. Okay, well, here's, for example, the Russell came right down, very oversold, a bounce. We're right back to the mean. Okay, the S&P. Okay. Come on. Very oversold. We're right to the mean. Okay. The Qs, the Nasdaq. Okay. Very oversold, right back to the mean. And of course, the diamonds would be probably the same. Okay. Right back to the mean. So now is the decision point. Okay. We've had a monster rally. Okay. So now you say, well, how do I play this? Well, I mean, there's different ways to play depending on what you trade. If you trade futures, you sell futures. You look for levels and you put an exit point in. If you're an options trader, maybe we'll look at, a trade in the SPY, for example. So if I look at the SPY and I go, okay, so I want to short the SPY. So how far out do I want to go to short it? Well, I wouldn't go dramatically far. I'd probably go to next Friday, for example, the 10th. Okay, so if I looked at it, I go, well, let's see, the at the money put is the 429. So I could actually, potentially buy that for the at the money put, I can buy for, let's say, 334. Now, is that the way to trade it? And my answer is probably not. That's not the way I would trade it. Okay, what I would probably do, okay, is I would actually probably sell a deep in the money call spread. If this stupid machine would work, okay, I would sell a deep in the money call spread. Let's say I sell the 430, 420. Okay, so I can get 724 credit. Okay, now but what I'm really doing is I'm buying the 430 put for $2 or $2.76 versus 380 on the board. Okay, so think about that for a minute. I'm buying a put for less money by selling a spread instead. Okay, so I'm giving up some of the time decay. I'm giving up the problems. Now, of course, obviously, to get such a good deal, it means you're giving something else up. Okay, so what else would you be giving up? Well, you're giving up the potential for unlimited profit. This trade is limited to a $7 profit, $7.24. Okay, that's the most I can make. But again, that's a move from here of about 2% lower. Okay, so again, do I think we're going to go a lot lower than 2% straight straight down in the next 8 days, hey, again, I can adjust my trade, but again, my initial cost is going to be significantly lower. I'm getting a 30 to 40% discount to do it this way instead. And of course, I can make this wider if I want. I can make this to 415. Okay. So now I've got, more. Again, there's all ways to make different trades. There's another trade you could potentially look at if you wanted, which would be like buying a back ratio spread, selling one, buying two. Okay. And of course, you need to overcome the width of the spread, which in this case is $1. Okay. So I'm actually paying a little bit more, but again, what I'm trying to eliminate is the unnecessary risk of time and other things that happen. So there's ways to create different types of trades. If I really wanted to get aggressively short, I could certainly just create a synthetic short, which would be creating a collar synthetic first, adding in an extra call to cover up the margin. Okay. Why is this always? There we go. Okay. So now what have I created here? Okay, let me make sure I got the right trend. I want this to be this, and I want this to be this. There we go. Okay. So now, once again, I'm buying the same as the 429 put. Instead of paying $3.38, I'm paying $1.08. Okay. So I'm getting a $2 discount here. Why would I do that? Well, again, I'm bearish the market. I think it's going lower. Okay. So if I look at it that way, so what am I doing? I'm selling the call spread. So the difference here is what is my risk? Okay. Again, we always have to understand the amount of risk that we are taking in every trade that we make. And my risk on this trade would be the $2 debit that I'm paying plus the $5 spread risk. So I'm actually risking almost twice as much, but I'm getting paid much faster. Okay. It's because instead of having to overcome 334, I've only got to overcome $1.02. Okay. So again, your job is to figure out what is the best trade that you can make for yourself that fits your style of trade, that fits who you are, okay, and what you want to do. Because again, there's a lot of different ways to skin a cat, as they say, and it comes down to what makes you better and happier, okay, to make these different types of trades, okay. And I think when you look at it, you got to decide. Now, again, I never buy naked calls or naked puts, except if there's 10 minutes to go to expiration, and I'm making an expiration play. But from if I'm going to put something on longer term, I don't want to take as much risk because I can put on more size if I want, okay, and have less risk, okay. I can do a lot of different things. So the key in the business is the risk control of controlling your money. Okay, so let's just as it looks like maybe we're a little busy. Let's see if there's any trades to make while we're hanging out. Okay, and we'll just take a peek and see if there's anything to do. And not really. Okay, there's not much volume. Again, one of the concerns that we have it's kind of quiet. Okay, so but again, if you're reading the footprint of the market, you're looking for levels of where you'd like to potentially sell. And of course, this would be the ultimate spot where I'd like to be a seller. But I'm already planning on what is the trade that I'm going to put on, okay, and where I want to be. And I think if you start to understand that and learn that, you'll be a much happier trader because you're going to be able to put yourself in positions of more strength and more power. Now, even if this market is going to go higher, what do we see or what do we know here? Well, we know that the angle in which it went up is way too steep, okay? When the angle becomes too steep, you have to have some reversion back under any circumstance. Now, it doesn't mean it's going to be today. The one thing you always have to remember is it doesn't mean it has to be today. It could be today, tomorrow, okay? But at the end of the day, okay, you want to make sure that you are understanding why that trade is going on and not because you read something in a newspaper or in the Wall Street Journal or in Barron's, or you heard it on TV. It's because the footprint that you've learned to watch is determined that the markets are still in a downtrend. B, they're reaching resistance. C, the angle at which they recovered was way too fast. Okay. So all those things being said, so the natural position is to be short. Now, does that guarantee that I'm going to win on that trade? No, it does not. However, all I'm trying to do is put myself in a position to make the best trade at the best time, okay, without influence of news, without influence of anything but what's going on here. So the only problem I see with becoming active today is you got the jobs tomorrow. Now, of course, the jobs could be anything and the markets could react anyway. But based on my knowledge and my history, I'd have to assume that if the job number is good, it's already priced into this market. Okay. And when you start to get the boat loaded on one side, and so for the last 3 days or 4 days, we've seen all buyers. Okay. So when I see that, to me, that tells me there's going to be some mean reversion, there's going to be some pullback. And again, it could collapse, which is what I think it will do. But either way, there's going to be some pullback. So I'm going to look to take advantage of what is mathematically probable, right? That's one of the things you want to remember is if you're trading a probability model, then you have to take the probabilities as they come. They don't just show up. You have to be prepared for them when they do come. So the way I would trade it, and then of course I've already done some selling, and I will do some more as the day wears on, because I'm not afraid of what the number brings out tomorrow. I believe that the number's already priced in. And one thing that you need to learn about markets is more often than not, especially in today's world of trading, the information is ahead of the market. You know, when I go back to my original trading days on the floor, we had 50 traders looking at 12-inch LED machines, right? They didn't have Windows. They didn't have DOS-based computers. We didn't have a phone in our pocket. We didn't have a computer in our, again, it was, so when they had news, it meant something because the news didn't get out as fast. Okay. If you remember the movie Trading Places, when they were waiting for the orange crop report, okay, nobody knew that information. So this is the difference between then and now is now the flow of information is so much that any big firm, and I assure you, Goldman, JP Morgan, those guys, they've got people that they're paying millions of dollars a year, not to get inside information, but to track like the weekly jobs number. Okay. If you know the right information to track, you're going to have a pretty good idea what that number is going to be. And you can bet they're probably already positioned, okay, for what they want to do. Okay. And I think that, again, these are things that are important for you to understand as you go forward, because again, the whole story of the markets is told here. It doesn't matter what I'm watching. Got Apple earnings today. Okay. Apple's had a straight spike up. What does it mean? Well, I mean, I would think that I'd like to be a seller at 180. I'd be a seller at 180 if it got there before earnings today. Okay. Amazon after its earnings has been exploding. And what are you seeing? You're seeing the common thread, okay, of markets that are too extended. Okay. That under any circumstances, the greater probability is that they're going to see some retracement. Okay. And I think, again, these are things that you have to kind of recognize, okay, is that markets are going to have some sort of retracement no matter what. Again, they don't go straight up. Even during the biggest bubbles of all time, even during the internet bubble of the 90s, the markets didn't go straight up. And you just look at look at Google, look at the recovery it's making. And Google's more stable, okay? It has not gone as parabolic. Look at Microsoft. We talked about this yesterday. It's breaking out, okay? And the key here is that, is this a false or is this real? So what I'd really like to see is, but what would be more healthy is a little bit of a pullback to support and hold before taking off. But this is not out of range as much as some of the others are. Look what's going on in NVIDIA. Nothing. It's just staying in consolidation, okay? Versus, the the Qs have gone from 341 to 361. Okay, that's an 8% move in 4 days. Okay, 7% move in 4 days. So again, you have to look at that and say, okay, so how do I take advantage of that? Well, again, you use the charts, you use the market to give you the best look at it. Okay, because that's all you're trying to do is put yourself in, again, the best overall position when you're looking at a market. Okay, and that's what we're trying to do and share with you is different ideas. Okay, you've got Square. Okay, I think they got earnings they have this morning or tonight. I don't remember, but it doesn't really matter. Okay, the spot, Tesla, that's all of a sudden popping. So again, if you're continually putting yourself in a high probability position, you're continuing to put yourself in a spot to have successful trades. Now, they're not all going to be successful, but you have to remember, again, what are your goals? What are your objectives? What are you trying to accomplish? Okay. And if you're trying to accomplish stuff that you've heard, like I said, the news is all bullshit. It's all, listen, that stuff is so old, it's almost an antique already by the time you hear it. All right. And I think that too many of us try to get caught up in some of these things that, again, they're not real. They don't mean anything. And I think that this is something that you as the individual trader have to recognize. Okay. Look, this is hard work. You ain't stealing anything by being a trader. Okay. But you're giving yourself an opportunity to make a lot of money, but you have to be willing to make the money. You got to be willing to take the risk to make the money. And the risk has to be defined by the size of your account. Okay. You should never be risking more than 2 or 3% on anything. Okay. And the way that you grow in this business is you grow organically. Okay. You grow by building a position. Okay. You grow by building yourself and by growing your account. So if you grow your account, then your position size becomes bigger. The whole, like I said, the charts are really nothing more than a bunch of geometric progressions. Okay. Your account is nothing more than a mathematical basis on what is the amount of risk I'm willing to take. What is, what kind of trade can I make here? How much money can I make? And then continuing to accumulate so that you can then, get bigger as you grow. So you get, as we call it, organic growth. So again, all I see for now is, again, there's a sell-off coming. Okay. I think we'll take out the recent lows. I can't guarantee anything, but I do think that's the nature of what we're watching. The only that is a concern would be the jobs number tomorrow and how the markets are going to react. But you would have to suspect that after a 7.7% rally in the NASDAQ, for example, I mean, how much more is there off of a news item that's probably already most likely priced in? And again, these are things that we have to look at, which is all part of your trading plan. And again, if you're trading, if you're trading futures or you're trading options, those are different plans. Okay. Because options, in futures, straight futures, just like straight equities, it's hard to control the risk without a straight stop. Versus if you're building an options position, you can build a position that tells you the max risk when you put it on. So you don't have to worry about an exit point because you're building it. The trade itself is building in an exit point. Okay. And that's something that you want to look at as you trade these markets. Okay. Is, again, what is to my biggest advantage? That's all you're trying to do, is take advantage of the overall market. That is your job. That is your positioning in life. If you're trading, is to take advantage of the markets to the best of your ability. Okay. And if you do it, you're then putting yourself into a position to make these calls without outside influence, without having an opinion of what is going to be next, but by simply looking at the overall market footprint. And again, whether I'm trading on a 4-minute cycle right here, okay, or I'm trading on a longer term, but if I'm looking here, so if I'm trading on a 4-minute cycle, I'm looking for an expansion of price and volume, either up or down. I need the volume to be either way. I don't care. but I need the volume to be big. Okay. And if the volume becomes big, then I can find a trade to make if there's enough price movement in either direction, because I'm going to take most likely the opposite side of that trade. Okay. The opposite of the movement of the market. All right. For right now, for example, gold was at a trade? Not really. I mean, but the volume was getting closer. The euro currency was at a trade? Probably not. Okay. Again, we're looking for more volume. The notes, there's a lot of things to look at, but again, it's recognition, because one thing you want to remember, okay, is all charts are the same. All patterns repeat themselves. Okay. And the shortest time frame will tell you what the trend is which way the trend is leaning, because a downtrend just doesn't appear in a daily chart. It appears starting in a 1 minute and goes forward. And I think if you want to become a much more proficient chart reader, what you want to really do is start by using a chart, okay, and like using a 1 minute chart, not to necessarily trade off them, because I'm not recommending that, but what it does do for you, if I go to a 1 minute, it shows me a pattern, okay? And on the 1 minute, I've got a nice little uptrend, okay? If I go to a 10 minute or a 15 minute, okay, I've got still an uptrend, and I can see now the parabolic move coming into play, okay? If I go to a 45 minute, again, these are just round times, you can see the consistency of the overall market until we get out to the daily, where daily we're still in a downtrend, right? So the short term is either indicating that the trend is going to turn and we're going to go higher, or that this is just a bounce. And you get your greatest clues by using a shorter term chart, because that's where, like, for example, we're looking to be sellers of the S&P. Okay. So if I looked at this on a 5 minute scale, okay, I would have been a seller right up in here somewhere. Okay. Now, again, I did not. I'm here with you, but that's where I would have looked at. Okay. If I were, and I will be looking at that when we're done here. Okay. Because that's, again, the nature that you're trying to pull here and create is to keep yourself in high probability shots. Okay. Knowing that the longer term trend is down. So this is nothing more than probably a dead cat bounce within that longer term trend. Okay. And those are things that, again, that you're looking for. And then again, it goes back to, well, what trade do I put on? And that's where you have to learn and study the different variables of the different types of trades that you can use. Because again, there's everybody's got different ideas, different types of trades. And believe it or not, when you combine all the options together, there's probably a million different trades you can make on any given thing, from ratio spreads to stock and options together, to futures and options together, to stock versus futures. There's a whole bunch of things you can do. Okay. It's, again, what you can do, B, what you can afford to do, what is your account support, how much margin you're dealing with. And again, then you have to weigh in on all the other things that go along with it. And that is the importance of first understanding where the market's going. Okay. What do you think the market's going? Where do I think the market's going? Well, I think the market's going lower from here. Now, am I right? I don't know. Okay. But based on the probability, I got a much higher probability of seeing a pullback than I have of seeing a continuation of the rep. Okay. And that's what you're trying to watch. Okay. You're going from, what kind of trade am I going to put on? Okay. So if we determine that we're going to look to be a seller, well, how am I going to get short? Okay. Well, I could sell the stock short. I could do a risk reversal short. I could sell a call spread short. I could sell the future short. Again, how do I want to do it? Where can I make the best of my opportunity? And that is something that we always have to make sure that we recognize is, where does our benefit come from? How can we do the best that we can do? And those are things that, again, for every one of you, that's your idea, is to try to figure out what's the best for you. How long do I want to be in the trade? What's the duration? Okay, because the longer I want to be in that trade, the more I'm going to have to pay to be in that trade. Okay, so there's a lot of little things, a lot of little quirks to think about. But again, we'll continue to cover these different things, and we'll continue to do these things together, and I will continue to give you market calls. And again, doesn't mean I'm always right. Okay. It's just, again, you can see certain things and certain things become much more obvious. So I think, be careful of the jobs tomorrow. Now, again, the jobs will be tomorrow before the market's open, the equity market. So if you're trading options, there's not a lot you can do. But, if you have a current position on, for example, okay, if you're long puts right now, for example, okay, and let's say the jobs number is really bad, okay, and the markets collapse. Well, you could actually trade partial options by using stock in the pre-market. But we'll talk more about that on Tuesday. Have a great weekend, everybody. Enjoy. Obviously, every morning I do a little 2-minute update, so you can always get that. And make sure you subscribe below. And thank you to all. We'll see you back here on Tuesday at the usual time. Thanks, everybody. We'll see you later.